Hello everyone, in this video we will discuss about history of Carvana. You've probably heard of Carvana and have even used it to buy or sell a vehicle. Carvana was the first in the used car industry to successfully implement a full e-commerce model. Through its website, the company makes buying and selling cars simple, and Carvana delivers vehicles directly to the consumer, eliminating the need for a trip to the dealership and saving customers time. The company is also developing new ways for customers to shop for vehicles, most notably car vending machines, which are glass towers that can display up to 30 cars for customers to purchase immediately. Consumers go through a process to verify their identity as the buyer, and the machine then delivers their car, providing an interesting purchasing experience that can be shared on social media and attract a large number of new customers to the platform. This may appear to be a sales ploy, but the company claims that it has already seen success with these vending machines, and it has surprisingly become one of the key selling points that management is committing to building out, as vending machine growth is highlighted as a key operating metric in Carvana's latest presentation. Carvana's story of revolutionizing the used car marketplace has helped it become a beloved growth company among consumers and Wall Street alike. This may appear to be a sales gimmick, but the company claims that it has already seen success with these vending machines, and it has surprisingly become one of the key selling points that management is committing to building out, as vending machine growth is highlighted as a key operating metric. Carvana's latest presentation. Carvana was founded in 2012 as a subsidiary of DriveTime in Phoenix, Arizona, by current CEO Ernie Garcia Jr. Ernest Garcia. Ernie's father is the head of a subprime auto lender. Both DriveTime and Garcia have a shady past. Garcia was convicted of bank fraud in 1994 while attempting to conceal 1,000 acres of land for Charles Keating, the infamous face of the savings and loan scandal in the late 1980s. And at the time, no stringent regulations were in place. These tailwinds aided Garcia and ugly ducklings' meteoric rise during a period when subprime lenders were popular on Wall Street, and by 1996, the company had no trouble raising $170 million for an IPO. The ugly stock went public in 1996 at $6.75 per share and quickly rose to $25. Just a year later, an analyst told the Investors Business Daily, "If you go to Tucson or Phoenix, people know the duck. It's an icon in those cities." By 2001, sentiment had shifted against subprime lenders, and the stock price had collapsed by 90% to new lows of around $2.50 per share by 2009. Garcia and Associates took the company private for $3.50 per share, at a huge discount of just around 5% of its annual sales. Carvana began as an online sales channel for DriveTime, but the company grew in popularity and was spun off in 2014 with a new mission of becoming an e-commerce platform. The company has relied heavily on new debt and equity to fund operations, which was exacerbated further by the pandemic when the pandemic first hit the curve on a stock price, which tanked along with the rest of the markets. In addition, on March 30, 2020, the company sold 13.3 million class shares at $45 each as a fully integrated e-commerce model that has delivered an impressive 87% category revenue growth from its IPO to the end of the fiscal year. Analysts have a strong consensus overweight rating of 2020. The company has benefited greatly from the semiconductor supply shortage, which has resulted in a 40% increase in used car prices versus 2021. Carvana has been able to maintain its hypergrowth momentum and scale significantly over the last 2 years as a result of this. However, beneath the surface of this fairy tale growth company, We'll look at how the company consistently bleeds cash while insiders cash out billions, why the company may be unable to raise additional capital, how its unsustainable business model is dependent on related party revenue, and how there's a high demand for subprime loans, and how the broader macro shift could expose the plethora of risks layered throughout the company, implying that Carvana's best days are now behind it. Raising $600 million in an offering limited to company insiders and certain existing investors. Carvana announced its first quarter earnings in May, posting strong revenue growth of 45% year-over-year, and the following morning, Carvana announced it was expanding its touchless home delivery to 100 more cities across 25 states. This news fueled a stock price surge, increasing the Garcia family's net worth by $2 billion over the previous week on May 15th. Carvana then announced a public offering of 5 million Class A shares at $92 per share and sold shares back to public investors at more than double the price. A lawsuit was later filed, accusing the family of insider trading and claiming that they used the pandemic as an excuse to buy shares. Almost a year and a half after the initial request, the SEC provided the most recent update in September 2021, confirming that an investigation into Carvana was still active and ongoing. It has been nearly 2 years since the initial disclosure in March of 2020. This raises the prospect that the initial inquiry has evolved into a formal investigation, posing a material risk to the company in 2021. We don't know the exact terms of the agreement because covenants aren't usually made public, but the high leverage ratios under all of these metrics suggest that the company may be restricted from incurring additional debt. The first is through a master purchase and sale agreement with Ally Financial, under which Ally has committed to purchasing up to $4 billion in loan receivables from Carvana until March 2022. As of September 2021, they had approximately $2.3 billion of unused capacity. The second method is to use variable interest entities or vehicles structured as securitization trusts, which securitize and sell a portfolio of auto loans to investors. Caravana began using this business model in 2019, and it is now the primary driver of its earnings growth. These are special purpose vehicles that allow a company to protect its interests by transferring certain assets from its own balance sheet to the SPV's balance sheet. It's fairly common to see these vehicles nowadays because they allow companies to isolate financial risks, and they're relatively easy to create and implement these vehicles carved on a box again on these receivables by selling them to Ally and Vicky's premium prices. As a result, the loan sales sold to Ally should account for a smaller portion of the total gain on loan sales. This implies that the loan sold through securitization would account for the majority of the remaining gain on loan sales, because subprime loans are much more sensitive to the expected default rate and residual risk.